Welcome to today's explainer. Today, we're taking the classic lease versus buy debate and turning it from basic math into a complete masterclass in financial strategy. I'm so glad you're joining us, because we're unpacking a choice that literally shapes a company's financial future.
Let's kick things off with a wild stat. Did you know 79% of U.S. businesses actually finance their equipment? That's according to the Equipment Leasing and Finance Association. So holding on to cash isn't just some niche strategy. It's practically the industry standard. Today, we're going to figure out exactly why nearly 8 in 10 companies are holding tight to their cash reserves instead of buying outright. Here's our roadmap for today. We'll hit the core decision, the hidden cost of cash, the ASC 84 plot twist, taxes and track leases, and wrap up with making the right choice.
Okay, jumping right into Section 1, the core decision, establishing the baseline for asset acquisition.
On the surface, it's a classic tug-of-war, right? Paying cash gets you immediate ownership and zero interest, but you take on the entire burden of depreciation. On the flip side, leasing definitely costs more overall, but it gives you predictable payments and, crucially, preserves your working capital. It's really a showdown between the lowest total cost and keeping your financial agility. But here's the kicker. The asset's lifespan should really dictate your path. Take fast-evolving tech, like IT or medical gear. That heavily favors leasing because you transfer the risk of it becoming obsolete right back to the lender. Think about a medical clinic. They absolutely should lease an MRI machine so they aren't stuck with a dinosaur in 3 years. But for long lifespan stuff, say a construction company needing an excavator for the next 15 years, buying cash wins there, so they dodge long-term finance costs on something built to last. Moving on to Section 2, the hidden cost of cash, making the invisible visible. We really have to look past the sticker price here. You gotta ask yourself one absolutely crucial question. What else could that cash do? We're talking about opportunity cost. What happens when you tie up your working capital in a single piece of equipment that's only gonna drop in value?
The real cost of paying cash actually includes all the profits you're giving up by not using that money somewhere else. Think about it. If you drop $100,000 in cash on a machine, you can't use that same money for a killer digital marketing campaign. You can't use it to buy bulk inventory at a massive discount, or hire a key player for your team, or even just keep it as an emergency buffer for a rainy day. So buying outright isn't just the purchase price, it's the price plus the earnings you just kissed goodbye.
All right, Section 3, the ASC 842 plot twist, and how new rules change the game.
Now, ASC 842 might sound like dry accounting jargon, but trust me, it's a massive shift. Basically, any lease longer than 12 months now has to be recorded right on your balance sheet to increase transparency. Your previously off-balance sheet leases are now front and center, completely changing how lenders look at your liabilities.
Because of these rules, the specific type of lease you choose is super important.
A finance lease acts just like a traditional loan. It's classified as a debt obligation and directly hits your leverage ratios. An operating lease, though, that's capitalized as a right-of-use asset and a lease obligation. It doesn't look like standard funded debt, which might actually save your financial covenants. But here is the sneaky risk hiding in the fine print. As CBZ notes, this right-of-use asset isn't tangible, but the liability is still added to your total liabilities. This means ASC 842 can accidentally trigger bank covenants. You could actually violate the terms of your other business loans because metrics like your tangible net worth or current ratio suddenly drop. So getting your lender on the phone before signing a new lease, absolutely vital.
Let's dive into Section 4, taxes and TRAC leases, leveraging specialized financial tools.
Your overall tax strategy should be driving your lease choice here. With a true tax lease, the lessor technically owns the equipment, meaning you get to deduct your monthly payments cleanly as operating expenses. But if you go with a non-tax lease, which is usually a conditional sales contract, you get the ownership benefits. That lets you write off the depreciation yourself, maybe even using those sweet Section 179 tax deductions.
And if your business runs heavy commercial vehicles, think semi-trucks or dump trucks, let me introduce you to your new best friend, the TRAC lease. TRAC stands for Terminal Rental Adjustment Clause, and it uses a preset residual value to completely change the math on your financing.
Let's break down why this is such a game changer with a quick example, a $150,000 dump truck. With a standard loan, you're financing that entire $150,000. But with a TRAC lease, you agree on a residual value up front, say $40,000. Now you're only financing the remaining $110,000. By stripping a 20 to 40% residual value right out of the financed amount, your principal physically shrinks. That means drastically lower monthly payments and way more cash flow for you.
Of course, there's always a catch, right? The trade-off here is residual risk. At the end of the lease, there's a reckoning. If that truck's market value drops below that preset residual, you're on the hook to pay the difference out of pocket. But hey, if it sells for more than the residual, you might actually get a credit. Plus, you can always choose to just buy the truck at that residual value or refinance it. It's an incredibly powerful tool. You just really need to understand how the end-of-term stuff works.
Finally, wrapping up with Section 5, Making the Right Choice, Your Decision Framework.
So, before you sign anything, walk through these exact steps. Step 1. Calculate the total cost of ownership and run a net present value analysis. Step 2. Take a hard, objective look at how fast that asset is going to become obsolete. Step 3. Talk to your accountant about ASC 842 so you don't blow up your balance sheet. And Step 4. Make sure everything lines up with your tax strategy and your working capital needs.
Look, whether you're a cash-heavy manufacturer snapping up durable goods or a scrappy tech startup trying to extend your runway, your choice has to serve your long-term agility. It's not just about finding the cheapest path on paper, it's about choosing the path that fuels your overall growth.
Which brings us to the ultimate question, the real mic drop moment for your strategy. Can your business generate a higher return on its cash than the interest rate of a lease? If the answer is yes, then leasing is your strategic advantage. It frees you up to invest that cash where it actually moves the needle. Thanks so much for joining this explainer. I hope this gives you the exact tools you need to crush your next big financial decision.